Have you ever wondered why some market trends capture global attention only to vanish into obscurity, while others fundamentally reshape our financial landscape? It is a fascinating puzzle, watching some phenomena burst onto the scene with great fanfare, then quietly fade away. Historically, we can identify transient market fads by recognizing their core characteristics. A rapid, often exponential, price appreciation driven primarily by speculation, rather than intrinsic value, widespread public participation fueled by emotion, and an almost inevitable swift and painful reversal that leaves few long-term impacts beyond lessons learned. They are distinct from enduring market shifts or even asset bubbles that might have some underlying, albeit exaggerated, innovation. The fundamental why behind these fleeting movements lies in a combination of factors. First, transient fads typically lack a solid, sustainable economic foundation or genuine technological breakthrough to support their valuation. Second, they are heavily influenced by behavioral biases, such as herd mentality and the fear of missing out, or FOMO, which propel prices for beyond any reasonable assessment. Easy access to credit or novel financial products can also amplify speculative activity, drawing in participants who are less concerned with long-term value and more with quick gains. Unlike true economic bubbles which may originate from a genuine, albeit overvalued, innovation, fads often lack even that initial spark of fundamental utility. To practically assess if a historical market event was a fad, you should analyze a few key indicators. Look for an absence of corresponding growth in underlying economic productivity or earnings during the speculative phase. Observe if the prevailing narrative was heavily focused on future promises and easy wealth, rather than current financial metrics. Furthermore, examine the demographic of participation. Fads often see a disproportionate surge in retail investor involvement, many of whom are new to the market and driven by stories rather than data. Finally, note the velocity of the asset's price movement. Fads tend to rise dramatically fast and then correct just as sharply, without leaving behind significant infrastructure or lasting economic change. A concept known as the greater fool theory often plays a crucial role in these fads. This theory suggests that prices can be driven up not because an asset is worth more, but because investors believe they can sell it to a greater fool at an even higher price. This speculative chain continues until there are no more greater fools to buy, leading to a collapse. Understanding the psychology of crowds and the power of narrative economics, which studies how stories and ideas influence economic behavior, is vital here. These elements highlight how easily market sentiment can diverge from rational assessment when powerful stories take hold. By examining these historical patterns and psychological drivers, we gain valuable insights into market dynamics. Learning to distinguish between legitimate innovation and fleeting speculative frenzies empowers us to better comprehend the underlying forces at play in financial markets, helping to contextualize both past events and potential future occurrences without falling victim to similar transient illusions. It is about understanding the enduring principles of value versus the ephemeral allure of speculation.